So we mentioned a couple of times that typically you guys want to look at the last 3 years of tax returns. Exactly how are you guys coming up, I guess, with the income for that part? Like, are you looking at, is it like an average of the 3 years, or how are you actually evaluating the tax returns? Is it the gross? Is it the net? Um, yeah.
Yeah, so there's a worksheet that I have, and that a lot of us, so as you go through IBBA training and other training, IBBA has an educational summit that's on valuing and pricing businesses.
Is
And
that the
so,
recap?
yeah, that's a recasting one. It's like 3 classes. It's IBBA 210, 220, and 221.
Mm-hmm.
And it's required as you're working for your CBI anyways. So it's just a great course to take. But you basically, they will teach you, and what you're doing is taking 3 years of revenue, cost of goods, total expenses. You're just doing that side by side on a spreadsheet or whatever, and then putting in your add backs, so that you can get to the seller's discretionary earnings. So you use a combination of the tax returns, and so that everything ties back to them, but you also use the P&Ls because the P&Ls tend to break things down into more detail. So for example, let's say on your tax returns, your insurance says $27,000. But on your P&L, it shows that 3,000 of that is maybe auto insurance, and the business doesn't have any vehicles. So you talk to the seller says, yeah, that's my personal auto insurance. Okay, well, personal auto insurance can be added back. And maybe there's life insurance, but it's not a key man policy, and it's not, it's basically the owner's policy. So that's another, let's say that's another 2,700. So that can be added back. The owner's health insurance for himself and his family, let's say that's another 9,000. And so when the owner leaves, the company's not going to be paying the owner's health insurance anymore or his family's. So that's another 9,000 that can be added back. So you see on the tax return the 27,000, but when you look at the P&L, you see that, 12, what, 14,7 of that can be added back, which is pretty good, because then when you apply, depending on what your SDE is, when you start applying multiples to that, that 14,7 can become, 30 grand or more
So
in additional
essentially, you're
value.
looking at the last tax return, but the other two are just kind of looking for stability.
You're looking at all three at 3 years because you're trying to find out, is the business growing? Okay, so is it steadily increasing? Is it flat? Is it declining? If a business is declining year over year, gross revenue and SDE, buyers first question on a buyer's mind is, has it bottomed out yet? And again, your multiple is going to be lower because they're looking at high risk. Business has been declining the last 3 years, it's a high risk. So then they're probably going to want to see the 2 years before that. Same thing if you have really fast growth, okay, really good growth over 3 years. Savvy buyers are going to want to see the two prior to that. They're going to want to see 5 years now. And I've had people ask me for 10 years of tax returns on a business that was selling for 250, and I told them go pound sand. I was like, are you kidding me? This is not a private equity deal, and the seller's not giving you 10 years. That's ridiculous. You don't care. On a business that's only 250 grand, 3 years is pretty much it. You're not going back.